Hey guys, Dave Keller here with Market Misbehavior. I was asked a lot this week and recent weeks about volatility, particularly the VIX. So today we're going to talk about what it means that the VIX has spiked so much in the last couple weeks. So when I'm asked about the VIX, I like to explain to people that this is, while it's known as the fear gauge, it's really a measure of volatility, or I would argue it's more of a measure of uncertainty than fear. Although, because it moves inversely to the S&P 500, generally speaking, meaning when the VIX is higher, the S&P tends to be lower. When the S&P moves higher, VIX tends to be lower. Because of that inverse relationship, people tend to call it the fear gauge, right? Because when the VIX goes higher, it tends to be a bearish sign for stocks. However, what we're going to do today is look at how the VIX is actually laid out in recent years, what a volatility regime means, and what you could make or should make out of this big spike in the VIX recently. Before we get to the charts, just want to remind you, if this sort of thinking about investor behavior, decision making, breadth, sentiment, momentum, all of those things is of interest to you, please subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below. Do you agree that this spike in the VIX is positive or negative for stocks, and why? Let me know in the comments below. Let's get to the chart. Okay, so we're starting with a 6-month chart of the VIX, and that's in the top panel here. I have some shaded areas, which we'll get to in a minute. In the bottom, the bars in blue are the daily S&P 500, the daily S&P 500 index going back for the last 6 months. So what does the VIX actually represent? This is the S&P 500 Volatility Index, is what it used to be known as. Now I think it's actually known purely as the VIX. And there are a series of derivatives, futures, and others that are derived from this measure volatility. What it's basically doing is it's giving you the implied volatility for the S&P 500. And what that means is it goes into the options market, looks at the prices of different options on the S&P and the volatility of those options, uses that to calculate an implied volatility. What is the implied movement of the implied relative movement in the underlying security, in this case, the S&P 500. So you can see just what's happened recently is as the S&P has rolled over, hit a new all-time high around 4750 there, third week in November, and then rolling over to the downside. Look at how the VIX has spiked higher. And that tends to be the movement, right? When the VIX is going up, markets tend to be going lower. When the market's doing better, the VIX tends to be a little more muted. So this looks like the highest reading that we've seen in the VIX, and it certainly is for the last 6 months. What we really need to do to understand the relationship is look a little further back. So now we're looking back about 3 years, and I'm doing this because you can see that 2019, 2020, and 2021 look very different using the VIX. In 2019, which was a year of relatively low volatility, the VIX tended to range between 10 and 20. Now, occasionally it got almost to single digits. A couple times it got to 20 and touched a little bit higher there in the summer, but overall ranging from 10 to 20. When the February 2020 market top occurred, when stocks rolled over here, and you can see the volatility went higher, we reached 40, which had been one of the extreme levels going back. But if you look, we blew right past 40, doubled from there, and went just above 80 for the first time in a long, long time. From there, the VIX has actually gone lower, and you can see that it remained fairly elevated. So if you take that big spike out of the way, most of 2020 was between 20 on the low end and about 40 on the upper end, 35 to 40. Look at how after the first quarter of this year, the range has come down even more. And for much of this year, we ranged between 15 and 20, or a little bit above there, maybe 25. So what's interesting is during this environment, what we sort of settled in on was this pattern. When the VIX got very low, around 15, that usually coincided with the end of a leg higher. You'd see sort of a pullback very soon. When the pullback occurred, the VIX would spike higher to about 20 or higher, and that's the time to buy because that's the Bible pullback as the price goes over. And you can see how that played out pretty well from sort of the spring, summer months really into the fall. However, now we're seeing things a little bit differently. The VIX has actually gone above 30. It's the first time it's been up there since January of this year, which was that first sort of big pullback in 2021. The problem with the fact that the VIX is so elevated, does that mean that stocks are going to bottom out? Not necessarily. And this is the problem. If you look back here in February of 2020, similar pattern of a bottoming in the VIX and rotation higher. You can see that it moved higher, but it didn't stop around 30. It just powered and ended up going 2.5 times higher, all the way up to just over 80. So the problem is there's no natural range bound definition to the VIX. It could go a lot higher than you might expect, and even a lot lower than you might expect. So how should we think of this breakdown? Well, now this final chart I'm showing you, I've actually inverted that top half. So I'm showing the VIX upside down, and here we have the S&P 500. And now you can see this relationship, this inverse relationship. So now that I've flipped the top chart over, you can see that the movements in the VIX very similar, match the movements in the S&P. And again, that's because the VIX is now plotted upside down. So these, instead of moving inversely to one another, tend to move in concert with one another. Here's the thing, though. If you look at what has happened for most of 2021, you had relatively low VIX. The line is very high. You can see the trend is fairly positive. Look how the VIX has broken down a lot more than stocks have. So what you're seeing when you look at the VIX and also the high yield spreads, which I don't have on the chart, but getting a similar idea, they're both breaking down a lot more. So while stocks are coming off a little bit, those indications are telling you that the fear or the uncertainty is much bigger and much more different than what we've seen in previous pullbacks in 2021. So while the VIX being spiking above 30 on its own does not mean we are currently at a low, what it tells me is that the fear is building and it's really expressing itself in prices going lower. But the spike in the VIX and the fact that it's so much higher than it has been for much of the year suggests that there may be further downside potential because of that extreme fear there. What I've always found with sentiment indicators like the VIX is on their own, they tell you one thing, but the indications you get from sentiment lead you back to breadth, talking about individual stocks and what they are doing relative to the broad markets, but most importantly, the price. It's most important to pay attention to the price of the S&P 500. I had a video earlier this week where we talked in a lot more detail about that. So if you combine that one with what you see here, you should have a good sense of the market in terms of price, breadth, and sentiment. So there we go. That's what to make of this spike in the VIX. Does that tell you just by the fact that it spiked above 30 that the market is bottoming out? Not necessarily. It's looking very similar to previous pullbacks, but it's also looking very similar to more protracted, more extended bear market phases. So as always, important to watch the price of the S&P and define your risk on any position, but particularly on a chart like that. If this sort of thinking about investor decision-making, behavior, charts, technical analysis, behavioral finance, trend, momentum, breadth, sentiment, if all that's of interest, I hope you'll subscribe to my channel. It'd be great to have you along the ride. Also, give the video a like if you appreciated it. We'd so much appreciate that back. Finally, put a comment below. Do you agree with my assessment of the VIX? Is there a different sentiment indicator that you'd like to use even more? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Have a good one. We'll see you again soon.